Hello and welcome. I'm Richard, and this is the Art of Arbitrage. I know it's Monday morning, and many of you may still be a little groggy after the weekend, but you need to be on top form to keep up with the myriad moving parts of the deal we are analyzing today. We are looking at the proposed takeover of Marel by JTB, a single merger, a friendly one at that, between two companies, but one that offers investors three possible exchange mechanisms, each of which will result in a different economic outcome. I hope you're strapped in wide awake and ready to keep up with all the options available. So, let's get to it. Marel is an Icelandic company founded in 1977 and a specialist manufacturer of equipment for the food industry. Their core specialty is developing and providing equipment, software, and services for automating processes in the poultry, meat, and fish industries. The company was listed on the Icelandic Stock Exchange in 1992 and continued to grow sales internationally and through several takeovers, which resulted in a secondary listing on the Amsterdam Stock Exchange in 2019. The company now has 7,500 employees, offices in 30 countries, sales in 140 countries, which generate annual revenue in excess of 1.7 billion euros and profits of almost 60 million euros. JBT, or the John Bean Technologies Corporation, can trace its roots back to 1884, when John Bean established a spray pump company in California. Over the next century, the company grew its product lines and sales and engaged in a series of mergers and takeovers. This resulted in the company becoming part of the multinational company FMC Technologies, until it was spun off as an independent company, JBT Corporation, in 2008. JBT now specializes in design, production, and servicing for products and systems for a broad range of end markets, generating roughly half of its annual revenue from recurring parts, service, rebuilds, and leasing operations. JBT Corporation employs approximately 5,100 people worldwide and operates sales, service, manufacturing, and sourcing operations in more than 25 countries. So far, so good. Everything is nice and simple. The directors of both companies are keen to complete the transaction. The shareholders of JBT voted overwhelmingly in favor of the deal at a special shareholder meeting last week, and the controlling shareholder of Marel, holding 25% of the company, has also undertaken to vote in favor of the deal. So, other than the usual regulatory approvals, what can possibly cause difficulty with the deal? The interesting point of this transaction is that JBT is offering shareholders of Marel three different options of how to participate in the takeover. Option 1, an all-cash transaction where Marel shareholders will receive €3.60 for each share of Marel they own. Option 2, an all-share transaction where Marel shareholders will receive 0.0407 JBT shares for each share of Marel they own. Option 3, a combination of cash and shares where Marel shareholders will receive €1.26 in cash and 0.0265 JBT shares for each share of Marel they own. The interesting thing is, because of fluctuations in the foreign exchange rates and share price volatility of the two companies, each of these options will return an investor a different economic return. So, let's take a look at the numbers. Let's start with option 1. JBT will pay €3.60 in cash per Marel share. When we plug the numbers into our spreadsheet and consider the opportunity for an investor in this deal, we see a purchase price of €3.27, a forecast closing date in December, an expected downside price of €2.30 per share, and with no dividend payment due. This means, should an investor take a long position in Marel today, they can expect an unleveraged return of 10.09%, which translates to an annual rate of return of 28.12%. As we discussed, the shareholders have voted in favor of the deal, and the Marel Board of Directors and the controlling shareholder are also in favor, only leaving regulatory issues as a possible impediment to close. This equates to a risk-adjusted return of 11.5%. If an enterprising investor were to use 50% leverage in the transaction, they could expect a return of 18.39%, or 51.24% annualized, for a risk-adjusted return of 18.76%. Now we can consider option 2. GPT will issue 0.0407 of its own shares for each Marel share. When we plug this into our calculation sheet and consider the opportunity for an investor in this deal, we see a purchase price of €3.27 per share, or $3.57 at today's foreign exchange rate. An exchange ratio of 0.0407 shares. A forecast close in December. A dividend of 20 cents on the short position. An estimated downside price of $2.51 and an upside price of $100. This means, should an investor take a long position in Marel today, they can expect an unleveraged return of only 3.99%, which translates to an annual rate of return of 11.12%, for a risk-adjusted return of negative 7.51%. This means a shareholder opting for the all-share transaction will receive just over half the return of the all-cash transaction. Now we can look at option 3, a cash payment of €1.26 and 0.0265 JBT shares for each Marel shares. When we plug this into our calculation sheet and consider the opportunity for an investor in this deal, we see a purchase price of €3.27 per share, or $3.57 at today's foreign exchange rate. An exchange ratio of 0.0265 shares. A forecast close in December. A dividend of 20 cents on the short position. An estimated downside price of $2.51 and an upside price of $100. This means, should an investor take a long position in Marel today, they can expect an unleveraged return of only 6.24%, which translates to an annual rate of return of 17.38%, for a risk-adjusted return of negative 0.60%. This third option is superior to the all-share transaction, but still inferior to the all-cash offer. However, one thing of note is that JBT shares have recently been adversely impacted by the broader market sell-off. If we now recalculate option 2, the all-share deal, but assume you were able to take a short position in JBT when the shares were still trading at $100, we can see a significant change in return expectations. A short at this price would have resulted in an investor expecting a return of 15.02%, or an annualized 41.85%, for a risk-adjusted return of 23.18%. This deal helps us to clearly see that the method of exchange is critically important to an investor's expected return, as is the price of the short position, as well as the long position in a share-for-share-based transaction. What do you guys think of this takeover? Let me know in the comments, and don't forget to like and follow if you found this video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price of the company, any change to the takeover price, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you, and until next time, enjoy life.